Hey everyone, and welcome. Today we're going to dive into a question that's right at the heart of our everyday lives, but honestly, it's a huge mystery to most of us. Where does money actually come from? Let's pull back the curtain and see how it's really made.
I mean, think about it. We use this stuff constantly. We work for it, we spend it, we try to save it. Our entire world revolves around it. But have you ever really truly stopped to ask, where did it begin? What is its origin story? Well, stick around, because the answer is way more surprising than you think.
You know, the image most of us have is of some giant government facility with printing presses just churning out stacks and stacks of cash. And sure, central banks do create physical bills and coins, but that's not even close to the whole story. In fact, that's just a tiny piece of the puzzle. The vast majority of money in our economy isn't printed at all. It's created somewhere else entirely.
So before we can get into how it's created, we've got to get on the same page about what money actually is, because it's more than just paper and metal. At its core, money is a concept, an idea that performs a few very specific jobs that are absolutely crucial for our society. Okay, so economists have boiled it down to three main functions. First, it has to be a medium of exchange. Basically, it's the thing we all agree to use so we don't have to, trade chickens for haircuts. Second, it's a unit of account. It gives us a yardstick to measure value, so we know a car is worth more than a coffee. And third, it's a store of value. It lets you save up your purchasing power today and hopefully spend it tomorrow. Just keep these three ideas in your back pocket, because they are key to everything that comes next.
All right, so keeping that in mind, how did we end up with the system we have today? Well, it wasn't designed in a lab. It actually evolved over hundreds of years, and it all goes back to a really clever idea from, of all people, the local goldsmith.
Okay, so picture this. Hundreds of years ago, you'd store your gold with a trusted goldsmith to keep it safe. In return, you got a paper IOU. Pretty soon, people figured out it was way easier to just trade the paper receipts instead of lugging heavy gold everywhere. And then the goldsmiths had this light bulb moment. They noticed that on any given day, only a handful of people actually came in to get their gold. Most of it was just sitting there. So they thought, hey, why don't we lend some of this idle gold out and charge interest? And that right there was the birth of what we now call fractional reserve banking.
And that is the textbook definition. It's the core concept of all modern banking. A bank holds on to just a small fraction of its deposits, the reserve, and then it lends out the rest. This is where things start to get really interesting and where the money creation magic happens.
All right, so that's the history. But how does this play out today? Well, this very system is what allows modern banks to do something incredible. They don't just move money around. They actually create brand new money, seemingly out of thin air.
To make this crystal clear, let's make it super simple. We're going to follow the money, literally. We'll trace the journey of a single $100 deposit as it enters the banking system and see exactly how this process works.
Okay, so let's say the central bank prints a fresh $100 bill. This is what you might call base money, the foundation of everything else. You get paid this $100 and you go deposit it into your account at Bank A. Right now, the total money in the economy is that simple $100.
Now your bank, Bank A, knows it needs to keep some cash on hand for withdrawals. So, for our example, let's imagine there's a 10% reserve rule. The bank holds on to $10 of your deposit. But what about the other $90? Well, that's an asset it can put to work. So it loans that $90 out to somebody else. Let's say to Sarah, who wants to buy a bike.
Okay, this right here is the aha moment. This is the whole magic trick. Sarah takes the $90 loan and pays the bike shop owner. The owner then deposits that $90 into their bank account at Bank B. So let's stop and count. You still have $100 in your account. The bike shop owner now has $90 in their account. Just like that, there is now $190 of money in the system, all created from that original $100. Poof, new money exists.
And it doesn't just stop there, not by a long shot. Now Bank B has a new $90 deposit. It keeps 10%, which is $9, and lends out the other $81. That $81 is spent and deposited into Bank C, which then lends out a chunk of that. As you can see from this chart, with every new loan, the total supply of money just keeps expanding, like ripples in a pond.
So what this really shows us is something super important. There are basically two kinds of money. There's central bank money, which is the physical cash and digital reserves that only banks can hold. But then there's commercial bank money. This is all the digital money that gets created by banks like Bank A and Bank B every time they make a loan. And here's the kicker. In most developed countries, this commercial bank money makes up over 90% of the entire money supply. Almost all the money we use is just numbers in a bank's computer system.
Now, a system where private companies can literally create money might sound a little bit like the Wild West, right? So who's the sheriff in this town? Well, this is where the central bank comes back into the story, acting as the ultimate regulator of this whole process.
The central bank has a few really big jobs. First, it's the supervisor, setting rules to make sure banks are stable and not taking wild risks. It's also the lender of last resort, meaning if there's a panic, it can step in with emergency loans to stop the system from collapsing. Most importantly, it's the overall manager, using its tools to try and influence how much new money is being created, all in an effort to keep the economy growing steadily without too much inflation.
Okay, so that 10% reserve example we used, it's the perfect way to learn the basic concept, but in the real world today, things have gotten a bit more sophisticated. Central banks realized that trying to micromanage bank reserves was clumsy. So now their main tool is the interest rate. By raising or lowering their key interest rate, they can make it more or less expensive for banks to lend, which in turn encourages or discourages the creation of new money through loans. And get this, because this one blows most people's minds. Major countries like the US, the UK, Canada, and Australia, they don't even have reserve requirements anymore. The official requirement is 0. So you might ask, what stops a bank from creating infinite money? Well, instead of that simple rule, they're constrained by other things, like needing to have enough of their own money, called capital, to cover potential losses. And at the end of the day, they still need to find credit-worthy people to actually lend to. And this right here is a perfect real-world example. It's a simplified look at a real bank's books. Just look at the asset side. You see almost $88 billion out there as loans. Now compare that to their actual cash and reserves, just over $3 billion. It perfectly shows that a bank's main business isn't storing money, it's creating credit, which then becomes the deposits you see on the other side.
So, we've gone on a journey from ancient goldsmiths all the way to modern global finance. But what does this all mean for your life, for your savings account, for your mortgage? Well, the way money is created has huge real-world consequences for every single one of us.
If you remember just one thing from this entire explainer, let it be this. In our economy, virtually all new money is created when a bank makes a loan. This means that for almost every single dollar of money that exists, there's a corresponding dollar of debt somewhere else in the system. Money is debt. The two are just two sides of the very same coin.
And living in a system like this has massive implications. On the plus side, it's what fuels economic growth. Creating new credit allows businesses to invest and people to buy homes. But there's a flip side, and it's a big one. If banks create too much money too fast, you get inflation, and the value of your savings gets eaten away. And because the entire system is built on promises and confidence, it's naturally a bit unstable, with the risk of crises always lurking in the background.
This quote really just hits the nail on the head. It perfectly summarizes the great trade-off we've made. We get a flexible financial system that can create the money needed for economic growth, but the price we pay for that is a system with built-in instability. It is an incredibly powerful engine for sure, but it can also be a very dangerous one.
And so that leaves us with a really, really big question to chew on. If our economy requires a constant flow of new loans to create the new money it needs to grow, what does that mean for the long run? Is our prosperity totally dependent on taking on more and more debt forever? What happens if that stops? It's a deep and fundamental question about the future of our entire economic system. Thanks so much for watching.